You know, the market, we just had this last rally, and what's amazing is, and what people don't realize, that every time that we have a major crash, you always have a rally before the last crash. Let me explain. It's always been when you have a rally, like we had like a 15-year rally, and once it peaked, and that means once the energy is gone, once the big institutions aren't buying anymore like now, that becomes your stage 3. That's the most dangerous stage, when the institutions leave. But what's interesting is when the market rolls over, it's always been 1929, this happened, 1972, 2008, always happened, that you get a rally first back to the upside. And why is that? Well, because the big institutions want to get their clients out. Goldman Sachs, the Morgan Stanleys, the Wells Fargo. They want to get their clients out, so they got to get them up in an upturn. So they do everything, tell stories, do whatever they got to do to push the market up. And then they sell into that rally. But 90% of the retail customer has no clue what's going on. Instead of, they're in there buying. They, I better catch this rally before it goes higher. Well, that's a bunch of BS. They're getting caught in a head fake rally. That's what's going on now. And the way to prove it's a head fake rally is you got to look at the volume. For example, the volume on the S&P is about 75 million a day. The volume of late has been only about 45, 55, far less than 75 million. So if you look at the chart, after we had that pullback about 5%, they started to rally it. But it was an insanity. They rallied it after the market went down 500 points on a bad GDP. Then it rallied and fell apart again. 700 points it dropped on inflation, wage inflation. And then they had a terrible jobs number. Instead of 240,000, it was like 175,000. Then they rallied again. And every rally, either was the GDP, bad GDP, wages bad, or the hot jobs number, or the cool jobs number, it was the same story. Oh, they're going to have to cut again. Oh, they're going to have to cut rates. In the meantime, you got all these people jumping in the stock market, thinking they're going to get rich. They don't look at the volume. Also, what they don't look at is the lack of consumer confidence. And this is really interesting, because the lack of consumer confidence is very, very important, because consumer confidence is everything. Think about it. If you're a consumer, and all of a sudden your wages have been cut back, or the hours that you work have been cut back, your confidence goes to hell. And consumer confidence has gone to hell. It's at a 17-month low. The fake business news network's not going to talk about that. They don't want you to know about it. So to them, they make it appear like it's like a gnat swinging around your head. Oh, get out here, get out. When it's very serious. It's very serious, because they start to panic. The consumer starts saving. And then what happens? They don't spend discretionary money, meaning they don't take the money they usually have for an appliance or a big screen TV or a van or car. They don't spend that. So what happens is the spending starts getting cut. Savings starts going very bad for the economy. We need revenue. And this is what's going on. But you don't hear anybody talking about it. Fake Business Network will come out and say a little thing about it, then nothing else. So, I mean, they're masking. Again, another thing. They just, don't worry about the yield curve. Don't worry. It's not important. It's been around for 2 years. Really? I don't have to worry about that? Oh, nah. Well, wait a minute. Then how come in 1929, 1974, 2008, every one of those major crashes occurred once that yield curve got beyond 500 days old? Each one crashed. Guess what? Our yield curve is now beyond 500 days. So we got a terrible situation with the yield curve, and we got a terrible situation with, of course, consumer confidence, and nobody gives a damn. Nobody cares. Nobody cares. So, and then remember the rates. I said this over and over to my gang members. How does it make any sense that for all these years, 13 years, the market from October 2009 to January 2022, 13 years, it only rallied because interest rates were at zero. And how'd they get interest rates at zero? They printed money, massive amount of money, to increase the money supply. When you increase the money supply, that's done by massive money printing. And they take the money and they use that money to go buy stocks for the Fed to push the market up. And that is massive inflation when you're printing money. In fact, it was really funny. Last week, this guy by the name of Jared Bernstein, he's a moron, but he's the president's top guy. He makes all the decisions for him when it comes financial. Someone asked him, and I'll play the clip, why are we borrowing money? Can't we just print it? Here was his answer.
The government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do?
Now, here's the question that was posed to him by this reporter.
Like you said, they print the dollar. So why does the government even borrow?
You heard his answer. He has no idea what he's talking about. This guy's in charge. So the problem is, from 2009 to 2023, we printed 8 trillion to 22 trillion. We increased the money supply. That's terrible inflation. So as the market is going up today, nobody's thinking about what I'm just talking about. Nobody thinks about it because it's no big deal. Hey, the market's on its way up. Look at that. We're on our way up. Gee, we're going to make an all-time new high. But remember, it's only going up on a fake narrative of, hey, guess what? They're going to cut interest rates because the GDP was terrible, inflation's terrible, and the job numbers came in hot. That's unbelievable. People are going to get caught in this market. Now, the beautiful thing, if you know what you're doing, you can take advantage of the stupidity, of this greed. Keep pushing the market up. Keep pushing the market up. Take advantage of it. Remember, when the market opens in the morning, I always tell my gang members, let's lose our opinion so we don't lose our money, and we'll just follow the cash. And that's what we do. And if a bunch of morons are jumping in the market, like what we call the tourist investor who has no idea what they're doing, let's make money. But we'll be out before anybody else. And thank God, because we have our color-coded chart that helps. So with this market rallying, everybody thinks now everything's okay. There's no stagflation. No stagflation? Of course there's stagflation. What do you need to prove stagflation? We have it. First, you got to have economic growth. GDP contract. It did from 3.3 to 1.6. The other component is you have to have price gains. And we have price gains. The biggest price gains in a year. The next one is unemployment. We have unemployment. Why do you think the consumer confidence is down? Because going forward, they have no confidence they're going to make the same amount of money they're making now because they feel they are not going to have a job. But when you listen to CNBC and Fox Business, there's no trouble out there anywhere. Everything's just fine. Or you listen to Aunt B, or you listen to Powell, everything's just fine. Well, it's not just fine. It's just not. So the one thing I've been telling my members is keep faith with gold, because gold is going to be beautiful. Because gold, at the end of the day, only gold is going to be going up, because we are going to have one of the biggest crashes ever. But nobody believes it. Nobody believes we're going to have a crash, because the market has been going up for 15 years. 15 years. Every other bubble, you go up for about 3 years, 4 years. This is 15 years. Because why? Because Obama, when he came into office, Biden, after Bush, he changed all the rules. One of the biggest rules that he changed was supply and demand. In other words, the only time we used to print money is when there was a lot of demand for goods and we needed to resupply. In other words, take, for example, if you're a bicycles and you always have an inventory of 100 bicycles, but your inventory went down to 10 bicycles. Well, what you do, now you need more supply. And there's a demand for these bicycles because the economy's good. People have not these crappy part-time jobs like we have now, but good, solid, full-time jobs. So as long as the economy is good and people are making money and they keep going by these bicycles because there's demand, then every time the supply of bikes go down, they print money so that factories can go in and make more bicycles. What they did during COVID, when the bicycles went down from 100 bicycles to 10, they didn't do that. Biden didn't do that. Instead, he let prices go up on the bicycles so people wouldn't buy them. In other words, if you're a store and you have 100 bicycles and you drop it to 10 and you can't get more bicycles, what do you do with the 10? If the bikes were $100 each, what do? You put them up to $400. And that's how we got such terrible inflation with Biden. That's what he did. Terrible. So inflation as of today, since the day he got in office to where you're today, is up 19%. That's insane, but that's where it is. Deficits are a killer. $1 trillion a year in deficit. They have to be paid. How do you pay them? You got to print money. More inflation. So going back to gold, when this market collapses, or even before it falls apart, always remember the beautiful thing about gold. Gold, okay, is a hedge against all this inflation. And when we have stagflation, you want to own gold, a lot of it. It's great to own gold when there's stagflation. And we are in stagflation, nobody will admit it. Now, gold is an inflation indicator. When you see gold going up, Japan, China, who loans us money, they want higher interest because they say, oh, look at that, inflation. See the gold going up, inflation. We want to make sure we got more collateral. We want higher interest because inflation is going up in the United States. We don't want to take a risk. We want more interest. That's the problem. But we give more interest, kills us. And gold, when gold goes up, stocks go down. And when gold rises, remember, it will rise on a weak dollar. So the more money they print, the dollar gets weaker, gold will rise. So every time they print, gold will rise. Wars. If there's a threat of war, gold will rally. Isn't that great? So if they're anticipating a rate cut, which all we hear every day, oh, they're going to do rate cuts now. Oh, they're going to do rate cuts. Oh, Biden stumbled on the way up to Air Force One. Now there's going to be a rate cut. Oh, Biden farted. So, oh, there's going to be a rate cut. Everything's a rate cut. What are you, nuts? That's great for gold. So my feeling is this, that yes, we're going to get a major crash and nobody believes it. And everybody's going to get caught off guard. But not us, not here at Phil's Gang. And that's why we're going to own a lot of gold. So I hope what I explained to you, I know it's totally different than everybody else. Everybody else says, oh, this is Goldilocks, everything's wonderful. They're going to have 3 cut rates between now and September. It's all bullshit. It is. Okay, so I hope this helped you a little bit with your portfolio. Remember, you can join my gang free for 10 days. Check it out, philsgang.com. See you on the chart.